Imagine walking into a sleek office in Silicon Valley. Glass walls, modern furniture. A receptionist greets entrepreneurs carrying laptops and polished pitch decks. Inside, investors sit around conference tables discussing companies that don't yet make a profit but somehow command valuations worth hundreds of millions of dollars. Every year, these firms write checks worth millions and sometimes hundreds of millions of dollars into startups they believe could become the next Airbnb, Stripe, Canva, or OpenAI. From the outside, it looks as if these venture capital firms are unimaginably wealthy. Most people assume they're simply investing their own fortunes. After all, when headlines read, "A venture capital firm invested $50 million into a startup," it sounds like the firm pulled that money from its own bank account. But that's almost never what happens. In reality, one of the biggest secrets in the startup world is that venture capital firms are usually not investing their own money. They're investing someone else's. That raises an obvious question. If the money doesn't belong to them, whose money is it? And perhaps more importantly, why would anyone trust a venture capital firm with hundreds of millions, or even billions, of dollars? To answer that, we need to look behind the polished offices, behind the startup headlines, and behind the billion-dollar valuations. Because venture capital isn't simply about funding startups. It's part of a much larger financial ecosystem, one that quietly moves trillions of dollars around the world. And surprisingly, some of that money may already belong to people like you. Let's start with a simple example. Imagine you've just retired after working for 40 years. Every month during your career, part of your salary went into a pension fund. That fund didn't leave your money sitting in a bank account. Instead, professional managers invested it. Some went into government bonds, some into public companies, some into real estate, and a very small portion into venture capital. Without realizing it, your retirement savings might help finance the next generation of technology companies. The same thing happens with university endowments. When prestigious universities receive donations worth hundreds of millions of dollars, they don't keep that money idle. Instead, investment teams work around the clock trying to grow those funds for decades into the future. They invest across many different assets: stocks, private equity, infrastructure, real estate, and yes, venture capital. Family offices do something similar. These are private organizations that manage the wealth of ultra-high net worth families. Some oversee fortunes built over generations. Others manage wealth created by entrepreneurs who sold successful companies. Rather than allowing billions of dollars to sit unused, they search for opportunities capable of generating extraordinary long-term returns. Venture capital often becomes one of those opportunities. Then there are charitable foundations, insurance companies, sovereign wealth funds, large corporations, even hospitals. Many of these institutions allocate a small percentage of their portfolios into venture capital funds. Not because startups are safe. Quite the opposite. Startups are among the riskiest investments in finance. Most fail. Many never generate meaningful revenue. Some disappear entirely within just a few years. So why would experienced investors knowingly place money into something so uncertain? Because venture capital doesn't aim for average returns. It aims for extraordinary ones. Imagine investing $1 million into 20 startups. 19 fail completely. At first glance, that sounds disastrous. But suppose the 20th startup becomes the next Nvidia, Shopify, or Airbnb. Suddenly that single investment could be worth hundreds of millions, or even billions, of dollars. One extraordinary success can repay every previous loss many times over. That's the mathematics behind venture capital. It's a game where failure is expected. Success is rare. But when success happens, it changes everything. This is why experienced investors aren't trying to predict which startup will succeed with certainty. They're building portfolios designed to survive many failures while capturing one or two exceptional winners.